You don't really have a business if you can't pay yourself. There has to be room eventually for your salary, for the chief executive salary. It has to be treated as if you would be hiring somebody at some point to fill that position. And if you don't have it, you really don't have a business.
Welcome to another episode of the Business 101 podcast. My name is Ayo Oye. There's nothing business owners love more than growth. But is growth always a good idea, or can businesses grow too fast? Today on the Business 101 podcast, I'm joined by Emmanuel Skevofilax, who spent the last 2 decades helping entrepreneurs grow their businesses without blowing them up in the process. Drawing from his years as a banker and advisor, he has seen too many profitable companies crash simply because they chase the wrong kind of growth. He's here to share why sustainable smart growth beats chasing flashy numbers and how business owners can build resilient, profit-driven companies with limited resources. So, welcome him to the podcast. Good to have you here, Manny.
Yes, thank you for having me, IO.
Yes. Manny, let's start right from the top. Right? What's your entrepreneurial story? You started in banking and then moved to eventually start your own firm. What did that look like?
Yeah, actually, I started in the restaurant business. My parents immigrated to America from Greece. We grew up in the restaurant business. When I got into first of all, they stressed education. They said, look, we don't have $1 million for you to inherit. But you better make
Yeah.
sure, that you get some kind of degree. We don't care what it is.
Yeah.
But meanwhile, I was, enthralled with the fast money. You could go home with cash in your pocket every day. So I did that until my late 20s. And I got my first degree along the way, but then I made the career change. When I was 29, I went into corporate banking, and I had a lot of great teachers and mentors. And after about 10 years there, I wanted to do something else. So I started a business as an outsourced chief financial officer. And I've been doing that for the past 22 years, helping business owners maximize profits and overcome growth challenges.
Yeah. Interesting. Manny, in your role as an outsourced CFO, right, you must have worked with tons and tons of businesses. And I'm sure you've seen businesses prioritize growth and grow so fast that they eventually get in their own way. What does that typically look like? And what are some of the causes that you've seen?
Yeah, that's a great question, IO. The first thing, in my opinion and in my experience, is, a business owner makes a decision that they want to take on rapid growth, and their business was doing fine. They had excellent financial metrics. Everything looked good from a financial perspective. And then they made this fateful decision to want to grow and grow fast. And what happened was their margins deteriorated. So they did grow the revenue of the business, but they started making less money. That's the biggest single thing I see over and over again.
Interesting. And what would be responsible for margin shrinking? Just for listeners who don't have a finance background.
You know, Based on what I've learned, IO, it's really easy to not take into consideration all of the expenses that are involved with growing. There's additional human capital expenses, there's overhead expenses. It's very easy to underestimate those expenses.
Interesting. And when that does happen, is it a thing where companies don't notice it early enough to be able to stop it? Or is it a thing where they are too invested that they cannot drop out?
Excellent point you make. So sometimes they're not tracking their financials as close as they should. Now we're talking about companies that are bootstrapped, so they don't have any outside investors. So that owner is wearing multiple hats in the business. Probably tracking the financials is not one of their favorite things to do. So that's one way that negative trends can take hold. And that would be the most prevalent way.
Interesting. And for the companies you've seen who kind of made this mistake and grew too fast, eventually when they noted that, okay, we seem to be in trouble, were they able to turn the tide around? Did they have to file Chapter 13 bankruptcy? Like, what is usually the end result?
Yeah, you're hitting all the excellent questions, IO. So in my experience, one man's
Mhm.
experience, I've had clients that recognized that they had a problem, that these negative trends had taken hold. Now, this is after they decided to engage a professional, right? So because some don't. Some are like, look, I started this business. I don't need anybody. I'll figure it out for myself. But others, they engaged a professional and they said, how can I be making less money? Or, this business is not meeting my expectations financially. So they engage, you're able to review it with them. They're able and willing to make changes, and they do a course correction.
Yeah.
And then there's others that they're like, what's the old saying? Damn the torpedoes, full speed ahead. All we need to do is sell more. I don't
Yeah.
mind losing a little bit in volume. And I don't mind
Bottom
losing a
line.
little bit on each sale. I can make it up in
Yeah.
volume. Hasn't every banker and consultant been taught that one?
Right. Yeah. 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 Interesting. Interesting. And Manu, you wrote a book, right? And in your book, you said that there are 8 common growth mistakes. First, can you talk a bit about your book and then talk as much as you can about these 8 mistakes?
Yeah, thank you. So, I had all this training. I had great teachers, great mentors, and these are the lessons that I learned over my career. I just kept seeing them over and over again, and I wanted a way to put them down on paper to be able to help. I didn't think the lessons were difficult. I always found that the bigger the business, the more simple the lessons were. So I was very blessed and able to have a publisher pick up the book. So, the main one about the 8 things that you don't want to do. Number one is, having your expense, making less money, growing the business, just to say from 1 million to 2 million to keep it simple in revenue. And you were making, let's just say $200,000 pre-tax when you had 1 million in sales. And now you're making 100,000 pre-tax when you're doing 2 million sales. You don't want
Yeah.
to do that. And it
Yeah.
happens every day in businesses of all different sizes. Margins get affected. So, that's one thing that you want to do. The other one is growing with debt. In America, we have this very, compared to the rest of the world, in my opinion, we have this very easy access to capital. When you turn 18 years old in America, a credit card gets sent to you with your name on it. So in
Yeah.
my case, it got sent to my mother and father's house when I turned 18, right? And it had my name on it. So you're constantly, it's easy to borrow money and you can make easy mistakes. You
Yes.
can borrow on your line of credit to buy like a piece of machinery when you really shouldn't be using that line of credit to buy a long-term asset, but you needed the money and you had the availability, so you borrowed. The other thing is financing losses. You keep losing money. The object of the game, I learned, is to try to build a business that's sustainable. That, there's 3 things. One is taking care of your employees, which is your most valuable asset. That's why you have to be profitable. 2, you want to take care of your family, right? And then 3, you want to be able to make your contribution to your community. And you can't do these things if you're not profitable. And taking on too much debt relative to your ability to repay it is another place where trouble can start. Another one that's interesting because of my background as a banker, there was a joke that they used to tell us. It's not really funny, but this is how they taught us. They said a banker will always lend you his umbrella when it's sunny out. All
Mm.
right. So but when you really need the money, a
Mm.
bank's not going to lend it to you. Meanwhile, for years, when you didn't need the money, they kept
They were
lending it to
throwing
you,
it at you.
right?
Yeah.
Over and over again. And then that one day when you really needed the money, um, they didn't lend it to you. So I've stressed over time, and I learned this, from my parents, from the 3 billionaire families that I've been blessed to learn from. They keep a very low reliance on borrowed funds. They don't borrow unless there's a darn good reason. So, those are like three of the biggest ones that we see every day.
Yeah. Wow.
3 of the growth mistakes.
Interesting. Interesting. And the last thing you said now is very profound because I feel like it sounds a bit counterintuitive because a lot of people are like, if you want to be a successful business person, you have to be comfortable with debt and taking loans and everything. But kind of to your point, right? That's taken at the wrong time and for the wrong purpose can definitely be a business's undoing. So yes, thank you so much for saying that. My next question is gonna be how does a business figure out the right piece of growth? And essentially, what are the steps they need to take to figure that out?
In terms of how fast to grow?
Yes,
Or
exactly.
okay. So in my experience, it's a personal decision. So there's 2 ways to do it. Every client that I've ever worked with, IO, they've got their costing memorized. They know
Mm.
exactly. They don't need a spreadsheet. They know
Yeah.
exactly what it takes to cost out a job or a project. They know exactly what it costs to produce one unit in their factory. They know all that stuff. So let's just take a trade contractor for a simple example. If they've got 3 trucks on the road servicing clients, they know exactly how much it's going to cost them to get the 4th truck on the road. They're going to need to
Yeah.
buy a vehicle. They're going to need to have the qualified person. They're going to need some tools, right? Some inventory and stuff like that. So they'll know exactly what the number is, and
Yes.
they'll know do they have the money where they can write a check? Can they go get a piece of term debt to buy the vehicle? Right. So that might be something that's done intuitively. You know, I'd like to get 5 trucks on the road this year, but I know it's going to cost me, $500,000 and I don't want to go
Mm-hmm.
borrow it. So right away that puts a little constraint. The other way is to run a financial model where you put your assumptions in and you say, I can grow my sales X this year, which will result in this much gross profit margin. I'm going to need these expenses. And on the balance sheet side, I'm going to need these capital expenditures. And as you know, that model will pop out
For your
eventually.
capital. Yeah.
When will you have a borrowing need? Right. And you can tell. So if you've got an assumption where you're going to try to double the size of the company and you can do it all with internally generated cash flow, by all means. But sometimes you can't because of the various constraints, and you'll see that borrowing need pop up in that model. So
Yes.
maybe it says you need $1 million. Well, do you have access to that million? So these are the determining factors, in my opinion.
This makes sense. That makes sense. And Mani, another thing you've said is that profit should come before big growth targets. This again sounds a bit counterintuitive to the general, truth that a lot of people have come to accept, which is that cash is king. And so you find a lot of business owners just saying, if I grow fast enough and, I'm able to sell and get money back, so long as I don't have like receivable stock out, I'm going to have cash. And whether I eventually turn a profit or not is less of a concern. How do you reconcile these two viewpoints and where do they converge?
So in my experience, this all changed back in 2007, 2008, when we had the
Financial
worldwide,
crisis.
whatever we want to
Yeah,
call that.
yeah,
They call it the Great Recession.
yeah,
Let's leave it at that. When that happened, so what do we have? We have boom and bust cycles, right?
yeah.
And so we went through a boom cycle and then it busted in 2007. So that means the banks aren't lending. So they're not providing that liquidity to grow. So if you don't have, okay, so we have to make sure that we're clear on what we're talking about. If this is a technology business, because we've gotten a little spoiled, in my opinion, over the last 18 years. If you have a technology business and you can rapidly onboard eyeballs, new clients, 1,000 a day, Io and Manny just sitting in their office with 2 computers and 2 desks, and we can onboard 1,000, 2,000, 10,000 people a day with very little cost of goods sold. And we're not making money yet, but we know if we get to 100,000 eyeballs, then maybe we're willing to sustain those losses
Mm,
and we have the capacity to sustain those losses. And we figured out it's going to cost us, 2 million until we get to this
yeah,
point, and then
yeah,
we'll print money. That's great. And then usually it helps if your company is funded by outside investors because
yes.
they understand better. They're professional investors. They say, okay, Io and Manny are saying that they've got 20,000 eyeballs and they need to get to 100,000. We believe in their product, blah, blah, blah. Great. But that's not for the average person that has
Yes.
bootstrapped their business. It won't work. If you're losing money every month, you're going to come to a point where you exhaust your capacity for borrowing money,
Yes.
and your bank is not going to want to lend you any more money. And that's going to bring on your day of reckoning. So I was taught to always make sure you're profitable. And then once you've got your recurring profit going on in terms of I'm making X amount on each unit, then try to grow it incrementally.
That sounds reasonable. That makes sense. What are some of the early signs that you've seen, Manny, of a business that's growing faster than it can sustain?
But what you mentioned earlier, IO, problems in the cash in the bank account. Okay. For a myriad of reasons, let's just go with simple examples. Maybe you're not collecting fast enough. You assumed you were going to collect your receivables. You're not collecting fast enough. But the problems will show up there. There'll be a strain, and you have to quickly move to make sure it's not an operating problem that somebody didn't, we assumed we'd be able to get 40% gross profit, but our salespeople are coming back and telling us they're only able to sell at 35%. That's going to change our equation.
Yeah.
So that's the first sign is problems with cash.
Okay. And two things that you mentioned earlier, bootstrapping versus borrowing money. In your experience as a CFO, what kind of businesses are better bootstrapped and what kind of businesses need to borrow money?
Yeah, that's a great question. So, in my experience, I think that a technology company that can rapidly onboard new clients is a better candidate. Because let's keep in mind, what I learned was it is not easy to get these outside investors, private equity, venture capital, whatever, to come and invest in your company. I mean, they're looking at thousands of ideas every month.
Every day. Yeah.
Right. But we don't understand that. We just talk about that at the dinner table. Oh, I'm going to go and get some investor money. And I'm like, wait a minute. It is
Where'd
very
you get it from?
difficult, right? To bring strangers into your company, explain what it is you're planning to do. And then you want to still maintain control. And people can't get
Exactly.
their arms around it. I'm like, we're going to have to give up control and these strangers are going to come in and now it's going to be their way, not your way. So to answer your question, I think the technology companies are best suited that can rapidly onboard new clients with low cost of client acquisition. And then like these businesses in America that are not glamorous, but they're consistent, like
Hmm.
manufacturers representatives, right? There are X amount of pumps, PUMPS,
Hmm.
for commercial buildings, industrial buildings
Yeah.
that are going to get sold every year in
Every
America,
year. Doesn't
right?
matter what the economy is.
Exactly. And I did have one client go that route because that was his business. He was a manufacturer's representative and, it was appealing and it was very successful, and of course he was a great operator. Let's make
Yeah.
sure because they're not just coming to
Okay.
give you money. They want you to
Yeah.
be a great operator and to run it. So
Deliver
again,
that.
in summary, if you have a tech business, because I like it because there's low barriers to entry, perhaps you can get some outside investor money. And then if you have a quote unquote boring type of manufacturing operation that's steady, I think those are the best candidates in my experience.
To be bootstrapped.
Yeah. To
Got
get
it.
the out to get
To
the
get
the
outside. Oh,
outside
okay.
money.
Okay.
Any
Okay.
business can get bootstrapped, right? The main thing is so you start a business, you have one client, right? You hang your shingle out, you get the first client, and then you take care of the client. And then you go from the one client to the second client with the same economic objective, right?
Yeah.
So if you're charged, $100 for the first client, you charge $100 for the second client. So you just make a little kind of cookie cutter repetitive model, but you don't take all the profit out of the business. That's what I stress. That's what I learned. You got to leave some of the money in the company, which becomes the new capital that you've created to use to finance your own growth. That's what I got. That's
Interesting. And that makes a lot of sense to me. Manny, let's make it a bit more practical, right? I've come to you and said, Manny, I'm in trouble. My business is growing extremely fast, but I'm not making any profit, or my profit is reducing. What do you say to me?
immediately. We're going to sit down with the financial statements and we're going to
Okay.
do a bank style credit review with comparative analysis.
Okay.
And I'm going to say, okay, all right. So it's what, July now? Let's just say,
Mhm.
let's look at what you did last month. How did the month of June turn out, the P&L? And we're going to compare that to the June P&L of a
Last year.
year ago, right? And we're going to do our year to date versus year to date last year. We're going to talk about the balance sheet, right? Do you have too much debt in here? Is the increase? So people have gotten caught off guard by the rise in interest rates. So a year and a
Yeah.
half
Yeah.
ago or whatever, 2-3%. If you had a $10 million line of credit, you were paying, two,
Okay.
three hundred, right? $300,000 a year in interest
Mm.
expense, or now at 10%, right? It's
Yeah.
$1 million, right?
Yeah.
It's
Yeah.
it's a lot of money. Even for a smaller business, $1 million line of credit, let's just say with 800,000 outstanding, it's 80 grand a year. You could have a full-time salesperson working. So again, that's in my experience. We would sit
Interesting.
down and hopefully we'd be able to find the problem, but that's what I got
Mm.
trained to do. So that's the first place we would go. Make sure the
Interesting.
financials are accurate, right? And the financials, which that's what we're trained to do as bankers, financial statement analysis,
Yes. Yes.
right? So that will tell you exactly where you need to go look by
Exactly.
looking at that
Yeah.
P&L, by looking at the balance sheet, by looking at the statement of cash flows. And it's all very simple. It's not complicated.
You're
Maybe they have a
absolutely right.
receivables, maybe they have
Yeah,
a collection problem. Hopefully it's not a P&L problem, because that can be painful to solve.
yeah, yeah, yeah. Interesting. Manny, so a lot of the listeners are actually first-time founders.
Okay.
That's the demographic that you typically see. How
Excellent.
should they be thinking about the decisions that surround taking debt
Yeah.
to grow the business, right? So a lot of you find a lot of people who started this thing with one or two people, bootstrapped for a couple of years. Maybe all the founders provided like 100K in capital. It looks like the business has a lot of promise, and now they're beginning to think about growth, right? Speaking to investors and things like that. How should they think about raising capital? Is the only consideration just control? Are there other considerations to think about?
This is an excellent question, Io. So look, I have had great teachers and mentors throughout my career, and they taught me to be conservative. This is like the common denominator, so I can keep it simple. They said
Yeah,
be conservative. And I learned a lot of that in the bank. That doesn't always go well with, it's not sexy. People want to
it's
borrow
not
money
sexy.
and get
Yeah,
outside
yeah,
investors, right? And
yeah,
double the
yeah,
size of the
yeah,
company this year. That's all
yeah,
great. But in my opinion, if you're a founder, just grow slowly. First of all, what is your objective? Do you have a business that can potentially catch fire? Do you have a technology business that's looking for eyeballs? Because those are the easier ones to get a market validation. If you do, then, great, but go slow. The challenge that we face, in my opinion, is we expand our lifestyles. It's very difficult to grow a business. Once you start, initially, you're going to be able to lease stuff. You can lease your computer, you can lease your
yeah,
equipment. Leasing companies are much more, I want to say, less strict when it comes to the financing piece. If you want to borrow money, your business needs to be at least 2 years old to go to the SBA. And that's an expensive proposition. Most people don't understand that until they get into the details. So the Small Business Administration is going to want your personal guarantee. Most people don't understand what that means. And then they're going to want to lien on your house,
yeah,
right? Then they're going to want your spouse to sign too. Nobody understands. It has to be explained to you. Now, I didn't understand until I went into banking. They
mm,
explained all that stuff to me. I'm
yeah,
like, why is this big constraint? The big corporations borrow unsecured. The
yeah,
little guy's got to pledge his house.
can
So
defend, yeah,
before you go that route, if you have a profitable business, just go slow. Go slow. If you made 100,000 this year and you pay, let's just say 30,000 in taxes and there's 70 left, don't take all 70 home with you. That's the key. That's what I've seen over and over again. Try to leave at least half of the money in the company, the 35,000, and take the other 35 home. And that 35 that you leave in the company is your own financing. You've created new capital. As you grow the sales, as long as you got the economic equation right, next year it'll be 70,000, you know, or
mm,
100,000, depends. And it takes time. We get enamored with these stories about overnight success, right?
yeah,
And it's the small, tiny percentage of people experience overnight success.
mm,
It takes a long time of doing the right thing to get that
yeah.
business stable.
Interesting. Something I've observed recently is that a lot of people start businesses with the aim to exit and sell
Mm.
at some point. And so what you find is a lot of people start businesses, they pay everyone else except themselves. And they're like, I'm just going to go as fast as I can so that I get this fancy valuation and I sell off. And then essentially pay myself. And that's one of the motivations of pursuing growth at all costs. Right? What would be your advice to small business owners on how to manage human resources and finance? Right? When is it a good idea to start paying yourself? When is it a good idea to defer paying yourself into the future? Things like that.
Again, this is, another bunch of excellent questions, IO. Very difficult. You don't really have a business if you can't pay yourself. There has to be room eventually for your salary, for the chief executive salary. It has to be treated as if you would be hiring somebody at some point to fill that position. And if you don't have it, you really don't have a business. And then let's just double check. If you're trying to achieve a valuation, that means you're losing money. So you need a funding source from somewhere. So we have to assume, I hate assuming, but let's just try it this one time. That you
Yeah.
have outside capital has come in and they're pushing you for these revenue targets and achieving these valuations. That really doesn't apply for the companies that bootstrap, you know. But the good thing is these people know exactly what they want to do. They're great planners. They have an exit. But I have to assume that they have outside money because, or a big pocket of cash. Maybe it's their own capital that they put in the business that they're burning through. Long story short, eventually they're going to run out. And it would be a shame. I mean, how would they live?
Mm.
It's a shame to not get paid. It destroys the business model. There's no business. And then what if you do manage to try to grow for 3 years and then it doesn't pan out? I don't, it's not worth it. You got to be taking money. Your efforts are very valuable. Now, where people overdo it is they take too much money out of the company.
Yeah, I was going to
Okay.
ask that next.
That's
Yep.
where it gets overdone. They start having some success and they're like, let me just take this money instead of leaving it in and I'm going to buy a nicer car or I'm going to upgrade my residence or I'm going to put a
Yeah.
pool in the back or serious,
Yeah.
because we want it all when we're young. All right. And those are the things that can interfere with growth plans,
Interesting.
in my experience.
Yeah, yeah, and yeah, I'm really glad that you added that caveat because that was going to be my next question.
All right.
Taking too much out of the business when it's young.
Uh-huh.
But one of the things you mentioned earlier, Manny, was the fact that you know bloated overheads can be one of the reasons why a company or a business is experiencing top line growth, but bottom line decline. Right? How have you seen entrepreneurs and business founders manage their teams such that they're able to essentially keep tabs on overhead while growing top line?
So in my experience, what I have seen and what I was taught was you need a good incentive plan. And then, now we get into the topic of leadership. Um, Entrepreneurs are, a different breed. They're used to doing things by themselves. They,
Yes.
generally speaking, some of them don't like to delegate.
Mhm.
So there's differences between that entrepreneur and let's just say some, professional managers that have gone through training and they've had a different level of training and experience to manage people. Number one, which is hard to do, you got to lay off the reins a little bit, delegate to the people, have a good incentive plan, and be open and honest with them. I found that most people don't want to share their financials with their team, and that can be a disincentive. They say, man, Io's making all this money. He doesn't share it with me. Meanwhile, Io's sitting with his CFO in a meeting. And they're like, hey, how are we going to make
Yeah.
payroll in 2 weeks? Right. But they don't know because you rolled up in a Mercedes, right? And you're dressed very well and you live in a nice place. They don't know that you're leveraged, that you've got your personal guarantee out, to the SBA on a line of credit.
Yeah.
Give everybody a job description and try to delegate and have a good incentive plan that aligns, your interest with you know, everybody's rowing in the same direction. That's what
Interesting.
I got taught by the billionaires that I was blessed to work with. They had these big empires and they had different cultures. They had companies in different countries with different cultures. It amazed me, right? Because I only know one culture, the American one, right?
Yeah.
you know so they had companies in England and continental Europe, where everything was different. I have a little bit of knowledge because I'm Greek and I'm first generation, so I can understand a difference in culture. So get the employees to buy in is the main thing.
Interesting. Interesting. Now that we're talking about getting employee buying, right? And specifically in the sense of tech businesses, it appears there's a very strict bifurcation between two types of people who work in tech or who start businesses in tech. There's I'm not sure how familiar you are with the Uber story, but the founder, Travis Kalanick, I believe, was a go, go, go. We have to grow, we have to grow, we have to go person. And then eventually, when he was ousted from the firm, the next guy that came in, Tara, I can't remember his last name now. He was, like you said, an experienced business leader who was more of a grounder. He was okay, we have to actually put in structures and grow at respectable paces, but in a controlled way and things like that. And when Travis was going to leave the firm, a lot of employees actually left as well because they were used to that go, go, go mentality, right? So as a founder, who is trying to kind of transition away from the sporadic growth to a more controlled growth setting, how do you communicate that to your team in a way that you don't lose good people who are motivated by insane growth targets?
Again, that's a great question, Io. And I think that's a very difficult challenge because people are, they have different personalities. To your point, there's people that's all they want to do is go, go, go all day long.
Yeah,
And, other
yeah,
people are different. They just,
yeah,
kind of want to have fun and, feel like they're contributing.
yeah,
you know, in my experience, it is a difficult challenge. And I keep coming to back to what I was taught, and that is the value of open and honest communication and share financial information with everybody. Let them understand. You might not need to go into the balance sheet because that can get complicated, but share how the company is earning money. Share the P&L, right? And then be open and honest. Don't try to sugarcoat mistakes, right? We all make them. Explain how the mistake was made and what you're doing to rectify it.
yeah.
That would be what I was taught, what I've learned.
That works.
What I read, because I really don't know what went on in Uber. Uber used to be one of my case studies where I would get into spirited debates with my younger business
Yeah,
owners because they never
yeah,
made a dollar for,
yeah.
I don't know, the first
For a
18
long, yeah,
years. It
yes.
was just, and I'm trying to explain this to a 38-year-old, and they're like, so what? They'll just go get you know, another
There was
billion
something
dollars
from them. Yeah,
at a
yeah.
$10 billion valuation. This is
Valuation,
crazy.
yeah, yeah,
So, and I guess as long as he was hitting the revenue targets, they let him get away with, sort of like a fraternity environment.
yeah,
I mean,
yeah.
this is based on what I read, so I'm taking it with a grain of salt, but you know, they probably didn't want to upset the apple cart. So I don't know, open and honest communication so we can keep it simple and let the employees know exactly what's going on financially in the company.
Interesting. And the people who are going to leave at some point, right?
Yeah,
Eventually,
yeah,
you're going to attract your kind of people.
yeah. And here's the thing, in my opinion, I don't want to mislead the employees. The employees have their
Mm,
own things going on at home. I don't want to
mm,
suddenly have to lay people off. And that employee was, might be having strained finances as it is. And because I wasn't communicating because I was embarrassed, now I got to lay them off and they're stuck.
mm.
The least we owe them is the openness, honest communication.
Oh, yeah,
And back to your
that makes
point,
sense.
some people are going to leave and some people are going to stay. So it's out of your control. Oh,
Yeah. It also comes to how you design the remuneration package, right? Because if 80% of an employee's remuneration is tied to growth goals, and then you see you're cutting back on growth, then they're going to be upset, right? So
that's a
do
great
you
point
think,
you make.
yeah, yeah,
Yeah. And then back to your point. So I have another debate with my business owners. I want the salespeople to make unlimited money. I don't want any
mm,
salesperson to have
mm,
any cap on their earnings, right? As
mm,
long as everything has been costed out appropriately, no cap. I don't want any salesperson coming in and saying, I'm maxed out at what I can make here. Go sell like we've instructed you to do at these parameters and have at it. That's how a company grows and
that
grows
makes sense.
profitably, you
Yeah,
know?
yeah. Okay, okay. As we begin to draw to the close of the episode, right? I'm minding from all of your experience working with, I don't know, hundreds, thousands of businesses. What is one, I'd say, anti-lesson, something that you've seen a lot of people do that you strongly advise against?
So I'll have to go back to assuming that the bank is going to be there. So
Yeah,
my main thing was I always help my business owners get into the commercial side of a bank because they start in retail, right? You open up your business, you go into the bank branch. So that's retail banking. So I
mm,
always help my business owner clients get onto the commercial side of the bank. So then they can access a commercial line of credit. However, they make the mistake of assuming if I have a bad month, if I lose money this month or this quarter, okay, the bank will lend me more money. Or
yeah,
if you have a collection problem and you've got payroll coming up and you can't make payroll and the payroll company needs to impound the money, right? 3 days
yeah,
before the payroll date, and
yeah,
you have to overdraft your account, the bank is
yeah,
not going to honor that overdraft. So
mm,
don't assume that that bank that's always been there for you. And I don't mean it in a bad way. I'm just being practical. Don't
yeah,
assume that that bank is going to be there in your time of need. Don't make that assumption. Assume the opposite.
Yeah, that makes a lot of sense. That's actually very profound, and that's a safe way to plan. As an accountant, I do have an ACA myself. Is the English equivalent of a CPA.
Okay.
Prudency concept is something that we learn as accountants, and that's a very prudent way to run a business. Assume the worst and be pleasantly surprised.
That's it.
I'm gonna give you one final opportunity, Manny, to kind of share like a takeaway. What's the one thing you would want someone to take away from this conversation?
To take it slow. Um, rapid growth sounds sexy and popular and all the good stuff. Just take it slow. Take it slow, one profitable client at a time. And then, don't beat yourself up. As an entrepreneur that's trying to bootstrap a company, give yourself a lot of love. There's going to be ups and downs. Only certain people are suited to be entrepreneurs because of the emotional ups and downs. So go slow and, don't beat yourself up. That's what I would say.
Amazing, amazing. Invaluable advice, Manny. Thank you so much for coming on the show.
Thank you for having me.
Yeah, good to have you. And I'll see you guys on another episode of the Business 101.